Welcome to today's Corporate Venturing Insider series. Today, I'm so happy to have Alejandro joining us. And maybe from Argentina, you will tell us where you're joining us from. But Alejandro, maybe we could start with a quick introduction about your journey into corporate venturing.
Thank you, Nicolas, for having me. My journey into corporate venture has been, I would say, a story that starts more from the energy space. I've spent most of my career working in the energy sector in different roles. And then ultimately, I think corporate venture capital allowed me to combine the two things that I like. That also includes an entrepreneurial slash impact aspect to the work that I do. Um, but yeah, I grew up in Buenos Aires, Argentina. I studied economics. I was mainly a sailor at the time, and I was sailing around the world. And when I was about to graduate, one of my sailing partners who was an executive in the energy space, offered me to join his investment banking firm in Texas. It was very far from home, but he basically, was turning around TXU, which is a large public utility, and needed some help. And we spent a lot of time sailing, and we always talked about energy because that's when I studied economics. I've also, I did my thesis on the oil markets, and I had an interest in that. So he basically said you should get a real job, and so I moved to Texas and I started in banking, restructuring companies in the utility space, power, then oil and gas, and then I pivoted many times in the space, but there was always this common vector in the energy space, and ultimately I had the opportunity to join this venture, this new fund, which kind of combined also the entrepreneurship element that I've had for many years in different aspects, and that's how I ended up in corporate venture.
Very nice. I'm going to pick on the selling because we have one of our investment associate, senior investment associate, Mark Boucher, who's also done selling. Is there anything that you've learned from selling that makes you a better investor?
Yeah, I think sailing. It's very interesting because it very well separates two concepts: the concept of strategy and the concept of tactics, right? And sailing is a sport in which obviously you want to go around the buoys as fast as you can, but the guy who wins is the guy that is ahead of the second one. It doesn't have to go as fast as you can possibly can, and that has a lot of elements of risk that you take through the regatta. So you think of a strategy long term, where I want to be,
Hmm.
and what seems to be the best way to get around the buoys. And then you think about tactics. It's like, how do I get ahead of this other guy, right? And that element, it's more the day to day of the work you need to get done to be ahead of your competition while keeping a focus on the strategy long term game. I think that's something that you take. I think uh, that you're all the time balancing risk in selling, and when you make your tactical decisions, things like avoid big mistakes at the beginning, try to consolidate a position. There's infinite things that have an analogy. So I would certainly say that I think a lot about selling when I'm at work.
Okay, very nice. And I think most of my question will be a combination of what's strategic, what's tactical. And I think some of the best practices touch on both. So I think it's going to be interesting. Now, one thing you didn't mention, and I'm not sure if it's because it's irrelevant to your job, but I doubt it, is your educational background. Do you mind sharing about what you've learned from your economics degree and the MBA you did, and how it's shaping you to be a better investor?
Yes, absolutely. I think obviously in the energy space, and in particular in the tech space in corporate, you're surrounded by scientists and engineers most of the time, and
Yep.
I think they will always say thermodynamics win. And thermodynamics are obviously super important to me as an economist. They're a variable that have something on the side called price that really also really change what makes the most sense. And a lot of times, I'm surrounded by discussions where people are trying to find the solution that spends the least amount of energy, and I am more concerned about for example, the relative prices of energy, right? And things that are more from an economic perspective.
Mm.
I tend to try to stay away from just trying to quantify things, KPIs that end up on a volumetric basis and not actually end up to a levelized cost. I want to put everything into a cost or a price. And I always think about or try to think about, well, that might be the answer in one place of the world, but it might be very different somewhere else. And that has affected me also because of where I did my different work experiences. I spent many years at Bain as well, doing energy in Brazil, in Argentina, and in Mexico. I've been through the deregulation of 3, 4 markets in the power space. So ultimately, I always tend to think, the thermodynamics will give you the guidance, and then we need to think about why, where, and how that changes the ultimate solution for any climate solution you're trying to implement.
Yeah.
So I think typically I'm the guy that only wants to see dollar figures, or I want everything to ultimately finish on an economic number. I think that has also helped me have a little bit of a broader perspective.
So my team knows that very well, but I have a huge bias on unit economics. And it doesn't have to be positive right away, but I want to see a path for them to become positive. But what you're describing is interesting because most people who are not technical in deep tech investing, they sometimes feel at a disadvantage. But actually, it sounds like it could even be an advantage to you because you're looking at how does that translate into unit economics and better numbers, profits, all of that, which then allows for scaling anyway. No point to have a solution to save the planet if it cannot scale because it's unprofitable. So, do you see it as an advantage that actually you're really in your zone of comfort with the numbers, and it's about translation of whatever people say into the numbers?
I think it's that translation work that I hope to do and how I hope to help my team. So, trying to get to that last, definite perspective by translating many concepts from different parts of feedback that you receive. Um, there's always these examples, and as you know, we're developing, for example, some lithium assets in the north of Argentina, and these are very remote assets, right? So sometimes a discussion, for example, on direct lithium technology is like, well, you're gonna have to have so many trucks coming back and forward because this technology, I don't know, uses more chemicals.
Yeah.
And I'm like, okay, but that's not a reason to strike it out. You should tell me how many kilometers, how we're gonna take it, what does it mean. So ultimately, I think I do try to push it to the final answer, and then I also try to push that solutions might be very geographic specifically. So you do need to understand power markets in many different places. I think I've had the fortune to have seen markets with $2 gas and $100 megawatt hour electricity, markets with $50 megawatt hour electricity and $10 gas, which ultimately keeps always your head spinning around where and why, right? And I think, the engineers and the scientists have spent less time exposed to these situations, and therefore are always less, I would say, less focused on how these dynamics might be different in different places. So hopefully, this is something that I help the team with.
Actually, I think it's a golden nugget, maybe not directly to corporate venturing, but really important for the audience to understand because we're talking about energy and towards a healthier planet. Can you explain why it is so geographically dependent for each energy solution? Because clearly the pricing is different in different geography, but why is that? And can you walk us through why some solutions will work in one place will never work in another place?
Absolutely. Yeah, I think, there was a world before the 2000s in which people used to say the relative price of gas and oil are linked. And that meant that somehow the technology solutions that we had would somehow switch back and forward, but would always kind of have the same relationship. When shale appeared and just this massive amount of gas started to showing up in some places of the world, this idea went out of the window and became irrelevant.
Mm.
And now really you have markets where gas can be free, and markets that obviously that affects the cost of power, but mainly also affects very heavily the price of heating. And there are other markets that gas is very expensive. I think we all tend to underestimate how bad gas travels. It's probably a big understatement. We were talking about you know gas in Argentina becoming zero cost because now oil production is going to increase and there's going to be so much associated gas with that oil.
Mm.
People are not drilling for gas; they're drilling for oil, and therefore all this supply, which means that you have gas for free. So obviously, we are thinking, how are we going to produce a clean product out of that, right? Out of
Yeah.
that feedstock.
It's very
And
hard to compete against zero cost.
it's very hot. We are always trying to think about how to use that gas without a combustion, because ultimately, 80-90% of the footprint of natural gas is a result of its combustion. So if you find ways to use it in a clean way, it's a very powerful tool to produce clean ammonia or other products. So the world has changed, and now we're in a world where some markets don't have gas and therefore have a lot of opportunities in the shorter term to try to electrify
Mm.
many aspects. There are economies that have very cheap gas, and thinking about straight up electrification is hard. But on the other hand, you have a lot of stranded gas. So hopefully we can produce a clean product that we can export better than natural gas. So I think we look a lot of relative prices and what opportunities to arbitrage will come. And hopefully, what we're really looking for is a technology that would enable this arbitrage.
I think that would be a good place where maybe we could co-invest, because I think the arbitrage is important, but also the pricing keeps fluctuating, and sometimes predictably, sometimes not. So, but Alejandro, let's go back to corporate venturing. And do you mind explaining your role and what is TechEnergy Ventures and how it started?
Absolutely. Well, I'm currently the Chief Investment Officer at TechEnergy Ventures. TechEnergy Ventures is a corporate venture of the energy company of Tekin Group. And Tekin, it's a large steel, energy, and construction group of companies, privately owned, roughly 100,000 employees, 40 billion revenue, and with a strong presence in Latin America. Historically, it's been a steel player. So big challenge to decarbonize. Um, the shareholders recognize that 95% of their EBITDA is linked to, let's call them, old legacy
Mm.
industries, and they have the ambition to participate in this new economy, and they have the ambition to be a leader in cleaning up their operations as well. So 4 years ago, the group decided to launch an energy transition division. And then very rapidly, they realized that they also needed a venture arm, because many opportunities were still, let's call them, out of the money.
Mm.
And investing in early staging hardware would enable them to have, I call it, a privileged window into the future, and to prepare to understand where they want to go and where there might be deployment opportunities when those technologies get to maturity. So I joined the group in 2021 to launch the fund. We've invested so far in 17 companies. We do things like geothermal, energy storage, carbon management, clean hydrogen, fuels, and critical minerals. We are doing a lot in the lithium space, so therefore also in the battery value chain. Argentina has one of the best brine resources in the world, and we have a lot of history with Argentina. So that's another area that we spend a lot of time. But ultimately, the group likes big scale assets. We believe that clean technologies will scale, and we want to be asset developers of those clean technologies when they're ready.
Well, first, I think it's inspiring, and two, I think it's very forward looking for what I think is typically an industry where incumbents don't try to change anything or move anywhere. So, 4 years ago, clearly a desire from the top management to prepare for the future. I want to double click on what you said, the privileged window of opportunity. Can you share a bit more what you mean by that?
Yeah, absolutely. It goes in hand with the idea of putting your feet on the water. And it's very difficult to observe and really learn just by reading the headlines. or
Mm.
just by going to conferences. You actually need to get your feet in the water to understand, for example, how fast battery costs are coming down,
Mm.
why, and how far they can get. And what does that mean then for the implementation of those solutions? So all the time we're pivoting in the fund between what we learn from the techs that are getting developed to what they mean in our geographies of preferences. We play a lot the game of saying when that technology gets to what point we'll be able to have an asset development go to an FID of $500 million to get built and make money in this climate, in this energy transition. And obviously, the more you spend time with your portfolio, the more you engage and the more you work to try to actually build these specific cases. And as the technology matures, the expectation of what do these cases mean evolve, right? So maybe when you start and you invest in a TRL4, you say, early stage out of the lab, you say, well, if you check these boxes, this kind of looks like the use case and this will be competitive. Then when they get to the next phase and they build a pilot plant, you start thinking about where am I going to put this plant? What geography that I mean actually makes sense? And then hopefully we're going to be evolving our perspective on where we're going to invest on the first asset as the technology gets ready. And we spend a lot of time with this concept of the bridge that we try to build. And it's the bridge between the business development team in the energy transition and ourselves. And how do we populate that knowledge to ensure that, we are big investors in geothermal? How do we make sure we're the first ones to go where we should go, right? How do we make sure we have actually the advantage of not just investing in the companies and being savvy around what's going on, but actually translating it into a business action in the broader business development ambition that wants to deploy $1 billion plus on anything they do, right? Because that's kind of the size of the group. Assets need to be hundreds of millions of dollars. If not, they're kind of irrelevant. So
Mm.
we're always trying to, I would say, lubricate this bridge, right? Trying to make sure that we're getting all the data to go through and to have them when the opportunity is that moving first will create a big advantage. It's not always the case, but when we believe the technology will enable a first mover to capitalize on a big advantage, we try to be very propositive around starting to do work on the business side.
And today you're part of that energy transition division, the CVC. Okay, so the strategic remit is very clear. It's about preparing the big mothership, oil and gas, to be ready for this energy transition we are seeing happening. And so
Exactly.
that bridge concept, how does it work in practice? Is that people in your team interacting with the rest of the bigger mothership, or is it the energy transition division that's doing it? How do you create this bridge? Because most of CVCs struggle with creating the right bridge, which are both efficient and effective.
Well, I'll start by making the disclosure that we're very young. So we build a hypothesis of how this should work, and we're working on it, and it's obviously work in progress, and we're there to tune it up as we can. But today, the way we define it is um, we have set what the outcome of each step should be. So we said when you invest, you should be able to say, this technology, when this happens, will be interesting in these cases. And
Mm,
that's, let's say, the output box.
mm,
On the other end, the business development side knows that eventually to get an investment approved, they need to come down and say, an asset in this region, in this piece of land, da 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 da. So it's very specific. And in the middle, it's the intermediate, let's call it business case validation, where you're starting to mix local data, local geographic data, because you're already saying in what region and why, with technology data. So today, the way we're organized is our team and the investor that is the expert in the vertical builds the model and the framework and gets the data feed in collaboration with the local teams that provide all the specifics.
mm.
And therefore, together we build the case. I think we take a little bit more ownership now because we don't want to have to do all the transfer of know-how. If we tell the business development team to, I don't know, model a geothermal asset when our team has been doing it all this time, right? Because they've been analyzing startups, it makes sense that we take over some of the analytic work,
Mm.
but we lever as much as we can the local knowledge to come together with a common recommendation or output that can serve for the management of the energy transition division. Say, yes, let's go spend money and, for example, lease land for geothermal, right? That would be an outcome, for example,
Yeah.
right?
So I can see the visual of the bridge, which is you have these two very different worlds. One which is very applied, it's about assets and exploitation, and then the other side which is all about the future, and there's very little data to prove it, and you need that bridge between the two. Now, what I'm assuming is that bridge, and actually you've alluded to it, some of your mothership experts can come in and bring so much insight that no entrepreneurs, no startups could ever have because they don't have this asset management experience. How do you make this into something that's so valuable for the startup they want to get your investment?
No, absolutely. It's a critical point. Um, when we also invest in steel companies, right? And one of the things that we always do is we invite them to come to our steel shops. And when they come to our steel shops, 10 million ton steel production, and they see these cities, right? There's always this kind of shock. So I think that there's an element of when it's a technology that we have to combine with existing industrial assets, there's an element of helping them understand how these big scale assets work and how do the teams that running think. So we get them involved with our teams for them to understand what does it take for these companies to make the decisions that they need. I think there's that element. When we are in the energy transition, let's call it more asset development, storage, for example, we push pretty hard into having them be laser focused on understanding the unit economics per geography, because this is there's no one size fits all, and we don't think it's a machine gun strategy. We think it's a rifle strategy. It's a systematic aligned rifle. When you start operating like a machine gun, I think you're dead. Basically, you're shooting everywhere, and you're hopefully trying to get something to hit, and you're not actually learning from shot after the other. I think when you do like systematic rifle approach, in a sense, where you're uh, deliberately pointing at different positions, but that allow you to learn from each sequence, you get much faster to the right answer.
Okay.
So
I don't think you should mention rifles pointing at the entrepreneurs, but I can see the point about high precision. I think probably investment thesis driven with hypothesis you want to validate before you go to the next step and the next investment.
yes, for example, the one clear example is energy storage, right? And you're operating in a market in which only in the US you have 7 different definitions of electric systems, right? One has capacity, another one doesn't have capacity, one has marginal cost, one is regulated, the other one is unregulated.
It's like a patchwork.
Yeah. So when people say, "Oh, it's in the money," I always it's like, "Where?
Where?
Why? What's driving those economics?" You need to understand them very well. You need to understand what do you need to get paid to make those unit economics work. And the same happens when you go across different segments, right? I think there's a lot of discussion around fossil parity, and my devil's advocate always makes me ask at what price of oil, because
Mm.
fossil parity, we had -$10 oil not too long ago. So it's a very strong statement. When I hear it, I tend to when I hear someone say we can compete with fossil parity, my first thing is to be scared about the comment, because
Yeah, because like you said, it's where and when.
yeah, exactly. So yeah, I think the business case needs to be very precise in a very fast changing regulatory landscape, and choosing the right market to go to. It's fundamental to be able to gain the scale to then hopefully one day be able to go everywhere, which is what you ultimately might want. but the first markets are very important.
To me, I think it's one of the golden nuggets, which is where and when really matters when you're looking at an energy solution to be deployed. And I understand your reaction when you hear cost parity, because there is no such thing as cost parity unless you define exactly when and where at one point in time. So now let's talk about the launch of the CVC. So clearly you joined for the launch. And I wonder, especially for the audience who are thinking about joining a CVC or launching a CVC, especially in a very mature type of company, in a very mature type of industry, what would be the questions you think they should be asking before doing so?
Yeah, I think my experience launching the CVC had two parts. The first one was mandate, so clarity around mandate,
Mm.
and making sure that personally I was attracted to the mandate as well, because in the end there's a lot of activity and there's a lot of I would say less well defined funds which do not have a clear mandate, and I think that very well leads to all these funds that do not survive more than one CEO. I think we all know. I think the stat is 30-40% survive a change of CEO or get changed. So to me, the first questions that I was asking was, are we aligned on what we're actually trying to achieve? Um, when I arrived, there were a set of priorities, and I told them that I wanted a ranking of priorities, not a set of priorities. I wanted to make what's first is first and what's second is second. Um, then I was clearly also trying to understand how we're going to measure it. Strategic. It's a very saying strategy or strategic is a very difficult word. It's too ambiguous to be clear, and I did want to make sure that ultimately we're all going to be putting the effort into the same things. So I would say to the shareholder and up, trying to ask questions around the clarity of the mandate, and where I thought it was not as clear, help them go from 30,000 feet, that was the mandate that I got, it was a 20-page document, to the first investment committee where I tried to go to 100 feet and say, okay, this is, now you said this, we all agree that we're trying to exactly do these three things.
Well, I think if you go to the investment committee, you could argue this even when the rubber hits the road. This is when you decide to land or not.
Yeah, absolutely. I did really want to make sure that um, if we were saying that the objective of the fund was to build new business development opportunities, or for example, decarbonize the group, what came first? Because you're starting a new team, you have
Hmm.
limited resources, you're trying to invest at the same time, you're trying to make the business case, at the same time, you're trying to share the knowledge and know-how with the organization. If you really think about it, the amount of work that you do in a CVC, it's significantly, I don't want to say more, but it has more elements than a straight up financial VC, with its advantages and its disadvantages.
Yep.
But I think if you understand very well the mandate, you can convert some disadvantages into strengths, right? So obviously, for us, there are things that are off the table. They don't fit a strategic mandate, and they might very well be very interesting investments, and they might very well be things that lead to great returns. Um, on the other hand, by narrowing and being strategic, you could have a know-how edge when it comes to choosing a technology or selecting a technology. So focus on the things where you're useful can end up becoming a strength relative to a financial VC that can do anything they want as long as it makes money. So I think we've tried very hard to balance the obvious disadvantages that we have as a strategic VC with the strengths that we can build, and that comes from how we selected the team, how do we run our internal process, how do we try to stay very true to our strategic ambition, as a way of thinking that's really the only segment where we can be competitive. Once we're out of the strategic map and we start fantasizing on doing things that make no sense, VC is very cruel. You probably end up with adverse selection. If
Yeah.
somebody wants you to invest, it's because nobody else wants to invest. So
Yep.
probability of success changes.
It's the start
We're
of the
facing
end.
it's a tough asset class. Like I tell my IC all the time, it's a very tough asset class.
Yeah. And it's one that's built on reputation. So you have to show, and I think it touched on the clarity of the mandate you negotiate upfront before the launch of the CVC. I think you implied the long term commitment, which means surviving a CEO change, which, even if you clarify, is never guaranteed. But I also like the fact you mentioned about measurement. How do you measure and communicate that performance to the stakeholders? But I do want to, so there is a strategic aspect and there is a tactical aspect, like you mentioned, for the investment committee. So maybe actually share with us, how was your first investment committee? What was the type of conversation you did not expect and was maybe harder than you expected, or something that actually was a delight for you? But that first investment committee, what do you remember, and what could the audience take away from that in terms of preparing for that?
Yes, I think the team and myself specifically, and then we find out the IC as well, was eager to get something done, to put one chip on the table.
Bias for action.
Yeah, there was an investment process that needed to be tested. There was a team that needed to be tested. So obviously, I remember we launched the website on January 15, and we went to our first committee early April,
That's
and
fast.
it was very fast. It was obviously a small investment. It was 1% allocation, so it was obviously small, but it was an opportunity that we thought provided all those elements, provided the elements of moving first, having a first deal done in a segment that we liked, that we didn't want it to build a large exposure, but we did want to build some exposure and some knowledge. The opportunity was aligned. We had to move very fast. And I was actually impressed by how fast we moved. And I remember the IC saying, specifically, we have an independent director that says, the IC needs to be ready to receive documents 48 hours in advance and vote. And when I heard that, I was like, wow. I never thought that they were really ready to move this fast, because one thing was saying we're ready to do it, and another thing is make a recommendation.
And you're talking, I'm sure, about very senior people who have very busy schedules. So I think setting that expectations, we have the same at TDK Ventures. Within 48 hours, we need to be able to assemble the IC and to vote. But we don't abuse it.
Yeah,
We try to give as much time as possible. But sometimes you need to be able to move fast.
no, absolutely. It was a delight to see that they were ready to walk the talk. And I think that was very, very positive signaling for us as we were building and mounting the team and the activities. And obviously, on the tactical side, uh, yeah, I spend a lot of time in private equity, so I've been through ICs before. So you know, you do have to do the pre-work, and you have to do the pre-work because you're hopefully trying to get the great questions ahead of time. So you know, every time you answer, you get rid of those great questions. What means is that the quality of the conversation will always elevate, right? If you're asking basic questions, in sailing, I always say the same thing. If you're talking about how to make the boat move faster with basic comments, you're not discussing on how the wind is going to change,
Mm.
right? Once you're a very good sailor, everybody knows what to do with the boat and everybody can be thinking, right? I think here is a little bit the same. Once you take out the basic questions around the business and the risks, and then we can evolve the discussion to a second derivative, and that
Yeah.
means that the conversation of the IC, it's much more acute, and actually it helps you really gain conviction, or just now realize that maybe it's not the right decision. But you do want to get to that level of conversation. You don't want to be explaining basic technology functioning, or you don't want to be explaining basic stuff. And if you go unprepared, it's very challenging, because you get to the IC, one question can derail an entire process. And that to me, it's the result of being unprepared. It's really not acceptable in our team that we're not prepared to answer basic due diligence questions. I think it's just it shows that you didn't prepare correctly. So we take that very seriously.
I think one of our own good learning is for the investment proposals to have a table that shows all the risks we have identified, the likelihood of them and the impact. And that preempt a lot of questions because then the investment committee members can go through this and decide which ones they really want to double click. But they feel comfortable that we've done the work. We've looked uh, as neutral as we can be about the risks. And so I think what you're describing is making sure you preempt all of the obvious questions. It's already addressed, which means you can be very strategic in the discussion about does that make sense as an investment versus is it a good investment?
Absolutely. The first time we were going to the IC, the risk table, which is similar in our case, has color coding on risk, and then it has basically probability or some assertion around likelihood. And there was a lot of red. And I
Yeah.
remember the discussion in my team was like, "This has a lot of red," and I was like, "Yeah, of course. This is you're in venture capital. This company is getting out of the lab."
And I think it's one of these very big difference because you're talking about investment committee members who have been, most of them, in big companies for a long time. They would never accept for a project to be so much red. But here the mindset is different. So maybe you can talk to me about how did you manage to educate, or maybe they were already there, for your investment committee members to understand that venture capital is so different an approach to what would be projects in your mothership.
I think we were lacking some aspects because there was a precedent through which the group had invested in the past, but only as an LP on a non-strategic venture.
Mm,
So there was already some gymnastics of understanding timing and levels of risks and the idea that the portfolio was going to have somewhere north of 50% of failures, right?
so they'd been exposed early.
Exposed, briefed, some combination of the two. Some had experience in that fund, one of the members. The
Mm,
other ones were very well briefed. And together with Andrea Roca, who is the head of the energy transition division, he also did a very good job at being very upfront during the entire beginning of the communication of the fund, not only within the IC but within the broader ecosystem of yeah, we're making this investment, this is venture capital. More than half of the companies we invest will go bankrupt, he would say, right? You need to understand the levels of risk, right?
yeah,
I
yeah.
think he was very um, forward in making sure everybody had the right level of expectations because it's not only the IC that maybe spends the most time, but then it's the entire ecosystem of people that get engaged with you, dedicate time, help you with that due diligence, that maybe help you follow through the technology progress of a startup that you're at. You got to keep everyone in the same boat of leveling the expectations because if not, they spend, they help us with the due diligence, they follow the company, then they go bankrupt, and they're, well, this was a waste of time. And hopefully, you have already helped them understand that it's a process through which this is the normal,
Mm.
uh, and that it's always an iteration of learning that hopefully you're building to always make better and better decisions. So it's not just the IC that I think needs to have the right expectation, but it's the broader ecosystem that you absolutely need. Because otherwise, how can you lever your organization if you create mis-expectations around the velocity at which these startups will be ready to be impactful? So the when, it's also an expectation that sometimes is hard to manage.
So I've learned something which I didn't know, which is your mothership had done an LP investment into a financial VC, which leads me to maybe a question for the audience, especially let's say you're the CEO of an oil and gas company. Does it make sense to do LP investments first to learn and to have your own executives learning about venture type investments? Or is it better to start with a CVC right away? Because from what you've described, it kind of helped the mindset of your investment committee to have done that first LP investment. So, how would you think about, you're the CEO of an oil and gas company, you're thinking about, or you're worried about what could disrupt you, and you want to create a CVC? What would be the step? LP first or CVC first? Or CVC doing the LP?
Yeah, I think the first question is around size of appetite. It's
Hmm.
very difficult to manage a CVC if you're not willing to put, I would say, $100 million on the table, some number that allows you to effectively participate.
Yeah.
So I think if you're still unsure and you're willing to put 20, $30 million, I would decide against having your own fund. It just, economics are not going to work. If you want to put a team with technical capabilities, you're going to spend some money.
Yeah, you're not setting them for success.
Yeah, the numbers are going to look really bad because you're still going to have, 4 or 5 people on that team, and if you don't have some strength, then it's very difficult to get access. So I would say if you're thinking about getting, just a smaller chip to start, I think finding some LPs as a first experience can be helpful. On the other hand, I find it challenging for an LP position to get the full perks out of an investment. I do think that ultimately things like the bridge that I described before, those are unthinkable.
Yeah,
Uh,
that cannot work the same way. I mean, you might have a meeting or two, but that would never be that kind of deep dive into how the two teams would work together.
exactly. So I think ultimately, if you're fully committed to leveraging tech to build the next phase of your organization, that means you probably have a bigger ticket you want to play with, and I think you will benefit from a corporate. If maybe you can have a corporate that also does some LP investments to accelerate gaining access. We've decided against to. We did the analysis. We looked at merit funds. We had a metric called the affinity metric, which we used to look at the affinity metric. So we would take the portfolio of any energy financial VC and say how many of these deals we would have done. First, on a segment based, just because of the segment, without judging whether the company you like it or not. Just would you
Yeah.
have invested in this type of tech, right? And then we would measure that against our strategic objectives. And if it wasn't north of 40%, we wouldn't really think about it. And we so far haven't found one. I think if we found one, we might do a small investment, I think, or to go to a new geography. But we've struggled to find something that would be aligned with such a strong strategic mandate.
Mm.
Um,
I think it's a very good, it's a golden nugget, which this affinity metric, which is from the portfolio of a VC, you would consider doing an LP investment. How much of these investments would be something you would be excited about, you know,
yeah,
and learn from?
yeah, do they fulfill your strategic mandate? Again, without saying I like company A or company B, just one step before, because then you obviously need to trust that you're leveraging their expertise to choose who's the winner in the segment. So not to contaminate that element, but but in general, there's incredible financial VCs. I know they're doing great work with their LPs. Um, we've looked at them. Uh, we're still open to doing things if we find the right partner to execute on things. But we found that putting our feet on the water it's better than someone else doing it and telling you how it feels.
Very nice. So clearly, you've talked about how quickly you can move for an investment. So let's go back to the advantage and disadvantage against financial VC. What do you perceive as your disadvantage against financial VCs?
Yeah, the first one I would say is that there are companies that would rather have financial players in general because they believe that the longevity of the teams it's longer. So typically, you do a deal with a partner, and the partner will always be there, and they will say that, who's going to be there tomorrow at TechEnergy Ventures, right? So I think some entrepreneurs perceive that today they're doing a deal with someone, but it's not a partner, and maybe tomorrow it's not there, or maybe the philosophy of the fund changes, or maybe the corporate changes its mandate. So stability and longevity from a financial investor, from the right financial investor, is something that I think sometimes entrepreneurs prefer. and hopefully we balance that with specific segment knowledge to offset that.
And it's fair. If you look at statistics,
It's
it
fair.
is fair.
It's fair. I think the second one there's a talent pool that wants to work in financial VC. I think it's a different mandate. I think it's a different task. But there's a talent pool that is obviously very good that wants to do that, and obviously they have great professionals that come with a lot of financial investment. They probably have a longer track record. If you take the average amount of years that my team has invested relative to the average financial VC, you realize that our team has a shorter experience. They have a lot more engineering experience, and maybe they have a lot more knowledge around certain power markets, but they definitely have a shorter tenure uh, in that sense. So I think that's another one. And financial VCs, some of them have been here, doing climate for 20 years, and that is something to say about them, right? So we understand that they have better access in general.
Yeah.
They have better access and they get first. And this is a very tough segment because if you invest in the seed round, it might be a fund returner. The same investment at the A round, it's a great investment, but it's not a fund returner anymore.
Yeah, and I think access is so critical. And you're right. Financial VCs that have been involved from the very beginning, Cleantech 1.0 actually was successful. It's just that it took 20 years versus 5 years. But if you are an early investor in, let's say, Tesla, you have a Tesla mafia starting startups in so many places, and having access to them is a real advantage.
Absolutely. I think in our case in particular, another disadvantage is that we don't have a US presence yet. I think that's something that we do want to work on. But today, we complement it with a lot of traveling, but you don't take an airplane to have a coffee with someone. So it's not exactly the same. So that's in our specific case that we have an office in Europe and one in Argentina. That is a little bit of a disadvantage.
Now, let's talk about something that both financial VCs and strategic VCs do, which is to bring value on the board. But entrepreneurs might perceive a strategic on the board very differently. Can you talk about, and you're on the board of a number of companies, I've seen that, some you're observer, some you're full board member with fiduciary duty. Can you talk about how do you address this with the entrepreneurs? How do you share with them how you plan to bring value on the board?
Yes, I think there's the first part of the pitch, right? So when you're looking at the company and you're building the case of how that's going to add value to you and should translate directly to adding value to them. There should be that link. There's very difficult to build a case where, oh, this is a great strategic investment to me, but it means nothing to you, right?
It's a two-way bridge, right?
So you gotta be really um, upfront and transparent on how you think you can add value, why and when. I think there's a lot of discussions, a lot of entrepreneurs look at us and say, "Oh, we're going to put a plant in one of your facilities." So we try to be very transparent about what it takes to put a plant in our facility, not to create false expectations, because otherwise, you close the investment and you go to the first board and they're like, "Well, sign me this pilot agreement," and I'm like, "Well, you're still pretty far out from being ready to put in a pilot plant." So
Yeah.
that very transparent an upfront disclosure of how you think you're going to be strategic and when you think that a collaboration will be ready and will make sense is very important.
It's a golden nugget. You have to set the right expectations on what you can bring and when.
Absolutely. Then the other one is if there is a potential perceived issue of conflict, also be very upfront. I think it comes with a previous disclosure, but if we're saying we're going to build assets in Mexico and the entrepreneur is saying, I want to build an asset in Mexico, you kind of need to address that upfront and say, well, you know what? Let's talk about how we would actually do something, even it's a little bit earlier, because is there compatibility in our ambitions? It's actually in our scorecard that their business model, even though it can change, and I strongly believe that you really don't know what business model you can pursue until the technology gets some maturity, because
Yep.
your competitive advantage will ultimately depend on how well your TRL 8 looks, not your TRL 4. Um, you know, but at least that compatibility around what each person is trying to get, it's relevant. And we try to be very transparent. And if there's a competitive element where there could be some conflict, just addressing how you're going to manage that. And that's, I would say, is the entire pitch part of when you're meeting the counterparty, and then see how that turns out. But once you become an investor, there's all these things that situations that appear that so far have proven to add value, probably beyond what the entrepreneur expected and what we thought that we could add value to. Some things is just more pure helping them with the management. Sometimes it's helping them with recruiting. Sometimes it's helping them by having expert calls with our teams. So earlier on, we find different ways to provide value in things that were less thought up front, but in the day to day proved to be of value to both of us.
You touched on something interesting, which we're discovering as well as TDK Ventures, which is sometimes there are some what we call TDK goodness, value we bring to our portfolio companies we never thought about. And yet, during a discussion between one of our portfolio companies and one of the TDK teams, a good idea surface. So I think there is a value to have teams discussing between them and discovering value. And part of an exploration mission is to find where value is. And at least on our side, we don't assume that we know all where the value would be. Now, you talked about scorecards. I'm very interested about what can you share about your scorecard and how have you maybe iterated on or improved it?
Yes. So we have a process in which we have a standard scorecard. It has 5 sections: um, strategic, market, technology, team, and I'm missing one. That is, financing. Let's say there's a financial block,
Okay.
use of sources, et cetera, around terms.
So not competition.
Competition, we do it within technology block, typically.
Okay.
And also depending when it goes to market. But if it's let's say pure hardware, there is a state of the art and competitive landscape analysis within the tech, and that's where
I see.
the unit economics actually finish in the technology section. Uh,
Makes sense.
and then basically, the last bucket is more financialist, deal terms, syndicate, more deal. Let's call it deal bucket. um, and it's from there's different questions from 1 to 5, and then basically what happens is that is the standard scorecard, which is also very similar to what our we call it answer first. It's a methodology that we actually took from Bain, that you build a hypothesis. The hypothesis need to be baked into the scorecard, so somehow you need to cover everything that you have in the scorecard. And we moved it. We actually don't look at the specific bottom ranking that much. We mostly discuss, the twos and the threes. So 3 is neither agree nor disagree. 5 is absolutely agree. So we spend time on the numbers, on the things that actually call out the attention. Sometimes,
Mm.
there is a strategic element. It's a 3. So there's a lot of discussion on, are we actually going to add value with this? How we're going to implement it? This is really valuable, and we try to have the IC focus on the things that are on the edge. We spend a lot of time also on the high conviction, because ultimately we think this is a high conviction game. You do gotta have things for which, the 3 reasons why you're investing, without going through a full scorecard. You gotta feel really good
Mm.
about them. But yeah, it's something that goes in every deal, and it's something that ultimately we iterate and evolve and try to improve it, try to make it useful. But that also serves to ensure that you're being exhaustive at the due diligence. You're covering everything. So it actually also helps drive the due diligence to make sure that you're touching on all the really important points through which you're.
So you invest early stage, but you have a private equity background. How do you reconcile the two? Because right now you're talking about being exhaustive, but there's so much you don't know early stage. There's so much uncertainty. How do you reconcile the two? Or how do you benefit from your private equity background to be a better early stage investor? I'm sure the audience, we will have some late stage investors very curious about this.
Yeah, I think my first disappointment, quote unquote, was to see that all the standards were, all the agreements were standard. I was like, oh,
Okay.
I was ready to make all these complicated structures to mitigate my risk, but here you can't really do that. Uh, so I think in general, um, it's a little bit of a different mindset. I think obviously in private equity, you go very deep into certain topics
Mm.
because you cannot tolerate a failure. Here, you have to have a higher tolerance for failure. On the other hand, obviously, when you look at private equity, you're targeting 4 to 6x to have a portfolio that has 2 to 3x, and
Yeah.
here it's a complete different game. So I think I would say more learnings have to do also with the portfolio management because I've been more exposed to seeing companies in growth phase. So when you discuss with entrepreneurs, you do bring, let's say, a forward look into things that will happen in their future. Um, I think in the due diligence, you you use less your knowledge around due diligence and how deep you go in private equity, uh, but you still bring some perspective of how does this need to look in 5 6 years to actually build an attractive business. And for that reason, we removed uh, one question that was in our scorecard, that was business model,
Hmm.
because we removed it because we came to the conclusion and the consensus within the team that it was the wrong question to ask at the lab.
That is a golden nugget already.
The thinking was that obviously you can have an ambition, and the ambition is always going to be to try to eat as much of that TAM as you can. But ultimately, your place in the value chain will be determined by how much better you are than others, right? If you're
Mm.
holding the golden key to a door, to a segment, yeah, the ambition should be to own the segment. And but until you actually de-risk the technology and see how everybody else evolved to understand if that is the case, it's very difficult to say, oh, well, his business model is to build, own, and operate and do everything. So, this is I like that business model. So, yeah, that's a good ambition. Or some people would say, I like it because they only want to do licensing. And I think when you're on TRL 7, 8, and you already start seeing the capabilities of the management and how they're setting themselves, that's a great question. But when a
Yep.
technology is on the lab, it's like, well, you don't know how good the technology is going to be yet. And their ability to navigate the value chain and decide how to integrate forward and backward and what's the right value, business model decision is yet too early to tell. So
So my last question is going to be touching this, which is with uncertainty of business model and go to market, how do you build high conviction? Because that was your point earlier, which is it's a high conviction game. How do you do that?
so there's I'll start by saying what characterizes our DNA that is very technical, like the
Yep.
group. And that has proven also to be challenging sometimes. I very much like people that say team, market, tech, and the team will solve everything. You know, I sometimes the counter view of that is wrong technical path, very difficult to fix. So I
Yep.
think the first thing is understanding what are you betting on at that startup, and what does the segment actually need. Is this a segment that will go through a technology disruption? And you're talking about new technologies that are order of magnitude better. There's obviously a technology element. How evolved the state of the art is, how competitive it is, how difficult it would be to scale, all those matters. If you are discussing a segment where you think that execution will win above tech and tech will be the commodity, you gotta focus on team. You gotta focus on who's actually going to be executing this. And then there's some segments in the middle where the market might not be big enough, and I will say that we take the strategic card and we say maybe the market is not big enough, but this would be fantastic for us to have in our portfolio because we can think of infinite ways to create value with this. So we try to be very upfront around what's driving it, and then we try to work on the bucket that we think will make you win that perspective.
I love your answer, and I like the granularity you bring to this question. So, Alejandro, thank you for your time. And I think I've said golden nugget a few times during this interview. So, thank you so much.
Thank you, Nicolas. It was a lot of fun, and hope to see you soon.
Absolutely.